The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, the show that is dedicated to anything and everything from the world of volatility. My name is Mark Longo, and I am your host for this fun-filled frolic through the world of volatility. And I am joined by none other than the man, the myth, indeed, even the legend himself, Don Schlesinger. Don, how are you doing this fine Monday afternoon?
Just great, Mark. Always nice to be here, and I hope our listeners had a happy holiday, a joyous Passover, and a happy Easter as well.
So how was your weekend, Don? Was it action-packed?
Well, it was a little bit quiet here. We had a lot of rain on Saturday, so I took in some sporting events, watched a little baseball, a little NBA basketball. But Easter Sunday was lovely, warm, sunshiny, so we got out a little bit.
You know, I had a bit of the opposite weekend. We have a little guy. He's a little over 2. So Easter weekend is a fun weekend full of chasing rabbits and all sorts of other fun activities for him. So, we were out and about quite a bit, and the little man learned to both dread and look forward to the visit of the Easter Bunny at the same time. And I can't say I blame him. That the Easter Bunny as a concept is kind of a bit of a frightening thing. The notion that a giant rabbit comes into your house and gives you eggs and presents is a little bit disconcerting for the average 2-year-old mind.
Takes a while to grasp.
Yeah, exactly. We almost had to bargain with him and say, okay, we made a deal with the Easter Bunny, and we will get your presents for you and leave them in the house, so the Easter Bunny doesn't have to come in. And he was okay with that compromise. That was a good compromise in his book. He got the presents. Yeah,
it's a little safer that
way. Exactly. He got the presents without having it interact with any sort of horrible bunny, so he was happy on that front. All right, Don. And with that, we're going to roll right into our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. As the name implies, this is the section of the show where we go back and actually review what's been happening in volatility over the past week or so. And again, due to the holiday weekend, we are recording a little bit later this episode. So we're recording on Monday. We'll be putting it out sometime on Tuesday probably. So a little bit later than normal times. But as you might expect, going into a long holiday weekend, we had a relatively pronounced sell-off in the good old VIX cash, that good old arbiter of volatility that we like to bandy about quite a bit on the show, both as a good barometer and as a sometimes confusing and less than useful barometer of overall volatility. But the VIX cash drifted downward last week. We saw it open up on Monday around 1830, and it closed the week at the end of the day on Thursday at 1469. And, we saw a lot of commentary in the broad media about, oh my, the VIX has sold off. What sort of complacency are we seeing in the market? And, of course, that type of activity is actually relatively common going into a long weekend. We have the weekend coming out. We have time decay being taken out of the index, and that, of course, tends to wreak havoc with the VIX cash calculation. That gets into, again, some of the reasons why the VIX cash, as a metric in and of itself, without a broader context, is a little bit confusing sometimes and can give some misleading signals. And, with the time decay coming out and everything else like that, that certainly plays into that pronounced sell-off. And a week like this, you'd expect the VIX to sell off and then pop back on the Monday after the holiday, and that's certainly what we're seeing today. We're recording this around noon on Monday, and the good old VIX cash is up nearly 8% today to 1583. So it's following the old pattern we've seen quite a few times. So the world is not as complacent as you may think by looking at the old metrics.
When I was on the trading desk, Mark, and selling options as I did customarily, I used to look at these weekends before, for example, Thanksgiving or just the one that we had before the Good Friday. And long about noontime on the Thursday before, I would say things like, you can almost hear the decay as you look at the screens, and the premiums would just be sucked out of all of these options because, as you just pointed out, and of course, as our listeners know, the Black-Scholes model doesn't know what day of the week it is, and it just counts days to expiration. So Saturdays and Sundays and Good Fridays and holidays count just as much as any other day. And as you just correctly pointed out, options traders don't usually wait until those 3 days are over to claim all of the decay.
No.
At the end of the period, they start anticipating, and a good portion of it actually comes out before the days go by, simply because they know there is going to be no trading on those days, and so they start early, if you will.
Yeah, that might be an interesting topic for a future show, is just the impact of time decay on vol metrics and volatility in general, just because we still see this to an alarming extent these days, as people coming in thinking that they could hit bids on Thursday afternoon going into the close and thinking that they're going to collect all that time decay over the weekend, not realizing that it was priced out long before. As you said, the options traders start shooting their bullets very early, Monday into Tuesday usually, when the long weekend's coming up. By the time Thursday rolls around, you're already trading on Monday's level, so you might as well.
You miss the boat if you want to start selling then.
Exactly. So in your parlance, it'd be better not to sell, or perhaps even to buy at that level than to just hit it and then incur all that weekend risk with absolutely no reward for your efforts.
Yep, you have to know the mechanics of the way these things trade.
And of course, as usual, we like to toss it over to our volatility pit reporter, the greasy meatball himself, good old Mark Sebastian from OptionPit.com, to talk about what he saw over the past week and what he's seeing coming up. So, Mr. Sebastian, take it away, sir.
Well, I would say it's not what I'm seeing, it's what I'm not seeing, and that's volatility. Okay? We started out with what seemed like it was going to be a promising week of trading, and then from there, you could almost hear the thwack of market volatility just pulling to a halt.
Is that a technical term, thwack, or is that a Batman term?
Oh yeah, you know the sound of a train colliding into 4 miles of concrete. It's kind of what it sounded like as the market just stopped. Now, part of that could have been the Easter holiday. We did have Good Friday off, or, Friday Observance Day, I think it's technically called now. And that was one thing, but the realized vol fell into the single digits. Implied vol fell into the low teens for the first time, below that 15 number. Now, you can say that adjusted for the weekend, it stayed above 15. The VIX stayed above 15. True. All right. The only real interesting vol we saw was in the commodities, where we saw a nice uptick in oil, a nice uptick in gold, a nice uptick in silver. And
it's all that,
that's
all
really
that reverse skew action that we see out in the commodities that fares all to the upside.
Exactly. There's really three types of skew. You've got your equity skew, which is your S&P 500 skew. You've got your commodity skew, which is your oils. Then you've got what I like to call breakout skew, which is your gold and your silver. Okay? And what that is gold and silver, unlike oil, have two types of traders. You've got investors in gold and silver, and then you've got users of gold and silver. So because of that, instead of getting a skew that's forward like in oil or backward in S&P 500, you get what looks like a U shape. Okay? And that U shape in gold and silver is getting increasingly steeper and increasingly out of whack. All right? If somebody said to me, Mark, where in the markets are you seeing opportunity to trade options? Okay, I would point toward gold and silver. And that's really what we've seen in the last week, and I think that's going to continue for the next couple of days. And that is my week in review.
And thank you for that, Mark. And Don, I know we also have a lot of other interesting activity to talk about in terms of some of the currency vol we're seeing and some of the activity we have going on there these days. What did we see over the past week? What was interesting going up in the Euro vol contracts last week?
Well, I'm happy, of course, things are always changing, but I'm happy to report that although volumes as a new product always experiences are relatively low, we're starting to see an uptick. We're starting to see increase in volume. We're trading a dozen, 15 contracts a day. And again, while that's light, it represents an improvement over the earlier days. And the bid-offer spreads are starting to get tighter still as market makers are getting somewhat more comfortable with the product and how it trades. And when you compare on a implied volatility basis to the associated options in the euro, we actually see that the spreads for the vol contracts are often almost as tight or sometimes tighter than those spreads for the options. So these are all positive signs. And a week or two ago, a new market maker, RSJ, who was very big in Europe, actually a Czechoslovakian firm, has been jumping in at times, and they're starting to increase their size to the point where we've seen some 50-lot orders come into the market. So that's rather encouraging. So
yeah, that's fairly sizable, 50 lots compared to what we've been seeing.
We're starting to see some liquidity, hoping that it'll develop further. And I think the key point is that we're starting to get some interest from a broader group of potential users, and we're encouraged by that.
All right, and with that, we're going to roll right into the strategy session.
The strategy session.
And welcome to the strategy session. This is the segment of the show where Don and I like to pick apart some interesting strategy or educational idea and delve into it in a little bit more detail. And we've hit on a variety of interesting topics and subjects over the past few shows. And a lot of them we discussed, of course, the difficulties of capturing pure vol using dynamic hedges and using delta neutral strategies and some of the difficulties associated with that. And I think a lot of our discussion there was geared around a lot of high-end retail traders and how they can implement some of that to perhaps if they've been trained to trade delta neutral, they can use a different way and use realized vol instead. And I think over the course of that discussion, one of the things we neglected to address was some of the professional institutional ramifications of doing that type of dynamic versus static hedging and some of the savings and some of the risk reduction you can get. Let's say if you're a market maker and you're looking to choose how you hedge your risk and how you hedge your options book. You know, there's different approaches to take to those types of hedging. And there's different benefits that you can gain as a market maker, as a professional, versus as a retail trader. And we didn't really get into that in the last episodes. I think this is a good time to dive into some of that material on this show. So without further ado, Don, I know you have a lot you want to talk about on this topic, so let's dive right in.
I'd like to point out to our listeners two very interesting, what I consider to be fascinating articles on the topic of volatility overlays and risk reduction, both for options market makers and for perhaps equity portfolio managers. I've told our listeners before that there's a wealth of material on the website, which is simply volx, volx.us, and I hope that some of them are having an enjoyable time taking a look around and reading some of these articles. First one that I'd like to discuss today is one that was authored by my colleague, and I jumped in a few areas, Robert Kraus, and we called it Volatility Hedging, Turn Up the Static.
To say, and Bob is quite the prolific fellow these days. It's just paper after paper, it seems like.
We're trying to turn them out, so we're having fun with that. And you'll see why in a minute, the little play on words with static. But first, just so that listeners can find this, if you go to the website and you look at the home page and the main menu, if you go to VolContracts, you get a pull down that will say opportunities, and then a further submenu of opportunities at the bottom. It says individual strategy articles. And this particular one, Turn Up the Static, is the one I'd like to talk about for a couple of minutes right now. What Bob did was to acknowledge the fact that most of the time options market makers are trying to delta neutral hedge their books and their risk exposure. Somebody comes in with a big order, makes the market maker either buy or sell. He's not going to leave it like that. He's going to probably get close to delta neutral through an offsetting position and try to hedge those deltas and some of the gamma exposure away. And so we started with that premise that a market maker would do just that, but we set out to see if there might not be a way to improve upon this traditional or classic way of hedging the vega and the gamma exposure of an options book. And so what we did was to assume in the Euro FX a very large array of options positions. We ran them different ways, both buying and selling. The one on the website is actually short options. So we took puts and calls, a couple of strikes above and a couple of strikes below the market. We sold 100 of each, so I think there are about 800 short options in this model portfolio, if you will. And then we set about to first use only the futures contracts and to delta neutral hedge the position. So we got a kind of a baseline, if you will, and we showed what the risk reduction might be to the exposure of using just that classic or traditional way to hedge. And then what we did was we overlaid a vol contract portfolio on top of the options, and we hedged away the portion of the options exposure that traditionally can be hedged away with a vol contract, which would be the vega, the sensitivity to volatility, and the gamma, the sensitivity to the changing deltas as price moves of the position. And what we found was rather startling. Of course, the most proficient way to do this is to use a dynamic hedge with the vol contracts, and that is to rebalance each night and make the hedge as close to perfect as possible. And we found that doing that kind of an overlay, there was obviously a very sharp decrease in the volatility exposure that came close to 70% further reduction in risk as measured by just the classical delta neutral hedging. But then we started to think, vol contracts are somewhat in their infancy. There isn't a huge amount of liquidity. It may be difficult to do this every night. What would happen instead of rebalancing every evening if we just considered a static overlay? And by that, I simply mean that at the very beginning of establishing the position, we would choose the appropriate amount of vol contracts and simply put them in place and leave them there. Leave them there until the expiration period. And I believe we did quarterly, so every 3 months we would consider a new scenario. And we did this for 5 years. So during some turbulent times in the 2008 period, we have 20 quarters and 5 years worth of data. And I can't say that we were surprised, but we were certainly very pleased to notice that the static overlay actually decreased the risk from the original traditional baseline way by about 59%. So it wasn't quite the 68 and a fraction percent of the dynamic. And of course, we wouldn't have expected it to be as good as rebalancing every evening.
Yeah, but you got most of the way there with a fraction of the cost.
Well, there you go. We got most of the way there. We got 86% of the reduction capacity there, and we did so with, of course, lower transactions costs and effort as well. You know, the concept of having to monitor every day and rebalance every day sometimes be somewhat of a pain in the neck. And so here you were, put it on and kind of walk away and forget it, and the results were quite dramatic. So I invite our listeners to take a look at this paper called Volatility Hedging, Turn Up the Static, and take a look at some of the documentation. And I think that they'll find it interesting, and I hope that some options market makers will take a look too and realize the potential benefits as down the line we start to come out with vol contracts on other products as well, that their options books could benefit greatly from this kind of activity.
So let me run that down then for our listeners who aren't market makers and may be curious as to some of the implications of that and what we were discussing there. But essentially, you know, like I said, market makers traditionally will use a delta neutral approach to hedge their risk and to capture pure volatility. We've discussed that in recent episodes. If you're curious about how delta neutral works, I encourage you to go back and listen to some of our previous episodes. But that's an imperfect process. And obviously, delta neutral will hedge your directional risk, and that's essentially it. You're still left open on Vega, you're still left open on Gamma, and a number of the other risks that are of concern to market makers. And so by using vol contracts, you can hedge both the Gamma risk, which is very interesting, and the Vega risk of the position instead. And there's two approaches to do that, doing it every night and going through a lot of different transaction costs to generate that perfect hedge, or just do it once at the beginning of the contract or the portfolio's life cycle and let it run to expiration. You can get the bulk of the benefits without all of the hassle and transaction. And I think that's a good point too. You never overestimate the impact of hassle. You know, we see that quite a bit in a lot of different areas who have yet to really adopt derivatives and options trading to a significant extent. I think a good example are financial planners and financial advisors who traditionally should be using a lot of techniques to hedge, like protective puts and covered calls and other things like that, other strategies like that are very well suited to long equity style trading, yet they don't adopt the product for specifically the reason you just mentioned, the hassle of rolling calls and rolling puts every month. And so I think on the same level, if you can find a scenario like this that can hedge Gamma and Vega risk and do it once cycle, that's a compelling argument, I think.
Well, I think that's a great summary, Mark. You really have captured all the main points. And again, in considering the Euro vol contract that we have trading on the CME right now, listeners or market makers might say, well, you know, I understand, but again, the volume is a little bit light at the moment, and that was the whole purpose of this. We will and can accommodate block orders. And so if you want to come in and you want to bid for 50 or 100 or whatever the question may be, we'll get you filled. And the concept is once you're done, you know, as you just said, you're kind of done for the 3-month period. And so basically, you don't have the worry about is the volume and the liquidity going to be there each evening for me. Put your orders in, we'll get them filled for you, and you can kind of sit back and take a look at what the results are, and we think you'll be pleased.
Yeah, I think that's an interesting scenario. I think that'll appeal to a lot of institutional customers who are A, concerned about liquidity, and B, concerned about the hassle of executing that type of dynamic hedge. If you can do it once per 3 months, that's like I said, that's a compelling argument. Now, Don, obviously, when you're talking about portfolio and portfolio management and portfolio risk reduction, the key metric that everyone throws out these days, the key metric that everyone's taught back in business school and even undergrad finance, is the good old Sharpe ratio. There's also some interesting analysis you guys have done over at Volex that talks about how you can use these types of hedging strategies and the vol contracts themselves to impact your Sharpe ratio as well. So why don't you give our listeners a little bit of an overview of those papers as well?
We have in our resources section on the website a fascinating volatility library that contains dozens upon dozens of scholarly articles and academic papers. And the one that I would point our listeners to for today's discussion is actually one that's in the implied volatility section because, of course, studies of volatility overlays for the most part have been confined to studies of the products that exist now and that are out there or have been in past years, such as the VIX futures. And now that we bring realized volatility contracts to the mix, we hope that as they start trading, academics will start looking at some of the data and writing some papers with vol contracts, just as we did our particular study with simulated and theoretical data. We hope, of course, to have empirical data and be able to join the ranks of the studies that are already out there. So this one actually did use VIX, but the part that's so impressive and so important is the actual enhancement of the Sharpe ratio to an equity portfolio. So the paper that I have in mind is in the implied volatility section of the library. The date that it was added is the 24th of October, so listeners can scroll down and find it. And it's a paper by three Belgian writers, or at least two of them appear Belgian, Marie Brière, Alexandre Burg, and the other looks Italian, Ombretta Signori.
I'm glad you tackled those names and not me.
They're from the Free University of Brussels, and the title is Volatility Exposure for Strategic Asset Allocation. And there's an extract. I'm not going to read it to you, but the concept is very simple. They overlay this type of vol contract or VIX futures contract onto an equity portfolio for the purpose of mitigating risk and reducing volatility. And they find that when they do so, they drastically reduce the overall volatility of the portfolio. And of course, with that comes an enhancement in risk-adjusted returns as measured by the Sharpe ratio. And then they add an interesting twist that I actually found fascinating, and that was incorporating some of the ideas that we've been speaking about in previous weeks about the risk premium, about looking for cheap volatility or selling expensive, and the value of volatility cones and making those kinds of assessment. They actually do the static type of overlay that we've just been talking about, but then they look to enhance it. And their manner for enhancing it is to actually look at when volatility gets stretched one way or the other. So they'll have the basic overlay, but they'll say in times of very rich and rather high levels of volatility, why don't we lighten up a little bit and sell off some of our contracts? And then, of course, just the reverse, in times when volatility appears relatively cheap, why don't we add a little bit more to this overlay? And traders will recognize this as what we used to call trading around a position. Have your basic position established, leave it alone, but then trade around. Look for opportunities to buy a little more and add to the position. Look for opportunities to sell a little more. And of course, they have their own metrics and guidelines as to how they make these decisions. But what they find is that when they do that, they do extraordinarily better than simply leaving the thing on. And so
surprise.
Yeah, in this particular case, the numbers are rather compelling, and it goes hand in hand with a second article that can be found in the library as well, where researchers, I believe, at Fuqua School of Business at Duke University found that there was anywhere from an 18 to a 25% increase or enhancement in the Sharpe ratio because the relative cost of establishing these hedges through the VIX contracts, or hopefully one day through vol contracts, is not anywhere near as big as the benefit that you get from the reduction in the volatility or the risk component. So everybody knows that Sharpe ratio is the excess return above the risk-free rate in the numerator of the fraction, and volatility in the denominator of the fraction. So the concept is if you reduce percentage-wise that denominator considerably more than you might the numerator with any cost associated with this strategy, the overall value of the fraction increases, gets higher, and that, of course, is the Sharpe ratio itself. So I hope listeners will have an opportunity to check this out, and perhaps we have some portfolio managers listening in. And if you are an equity portfolio manager, or even if you have a portfolio of FX on which we already have our Vol product, check out some of these strategies and perhaps begin to explore using them for your portfolio management.
I always like to see these academic papers add some sort of, like you mentioned, a dynamic or an additional trading component, because all too frequently we see these papers come out and they'll create a static position and they'll let it run to expiration and they'll analyze that, and that isn't very reflective of the way a quality or a skilled portfolio manager or a skilled trader would handle that position. Like you said, they would trade around it. They would do day trading to add or reduce that position a little bit, and so adding just that extra layer to an academic study like this, that does reflect far more accurately the way the position would be handled in the real world. And I think it makes studies like this a lot more relevant to active portfolio managers, active traders, because it reflects the way they actually trade in real life versus some academic abstract that is of little or no use to anyone.
So that's the part that's really nice about this. When we wrote our other article with the static return, we put it up there simply to show that, interestingly enough, even though it isn't the tried and true method for trading this type of overlay, the results were rather compelling in and of themselves. And then anyone who, as you said, is usually inclined to not just sit on his hands, but actually trade around, well, then you can expect even further enhancements in the real world trading. And obviously, that's good to know as well.
All right, and that's going to do it for our strategy session for this week. And with that, we're going to roll right into a listener mail segment.
Listener mail. Listeners right in.
Mail's in.
And welcome to the listener mail. We've got some interesting feedback from our listeners here. And before I dive into it, I just want to make a quick note that people have been sending us a lot of interesting comments and questions, and they've been using a variety of means to do that, which is fantastic. But when you're coming to the forum, I would request that you do post your questions or your comments in the Volatility Views forum. I know there's a lot of sections in that forum. There's different areas. There's the option block one. There's other areas of the site. But we're finding questions for this show buried in other segments, and it makes them difficult to get them on the show and answered for you in a timely manner. So with that said, if you're going to post in the forum for this show, then surf on over to optionsinsider.com/forum and then scroll on down towards the bottom of the page, because it is posted in alphabetical order and good old V comes near the end. So scroll on down to the Volatility Views forum and post your questions for Don and myself in there. And our first question comes from a user in our forum who goes by the name, I suppose that's Yoda. He's spelling it differently, but I guess I'll just call him Yoda. And he asks about the disadvantages of variance swaps. And he says, despite the advantages, variance swaps should have a few disadvantages as well. Any idea on what these could be? Thanks in advance. And this is, of course, referring to the show we did a few weeks ago discussing the OTC variance and volatility swap markets. And we hit on a few of the disadvantages in that show, but we can just reiterate them and get into a little bit more detail here. I think the big disadvantage that a lot of people learned the hard way into late 2008 into 2009 was that these are indeed OTC products, so that implies an enormous amount of counterparty risk. What we saw in what we mean by that, just to break it down even further, is that essentially you, unlike a listed exchange where there's a clearinghouse that takes the other side of your transaction and is pretty much unless the world implodes, are pretty much guaranteed to be there to close out your transaction. You're trading with one party on the other side of a phone. You'll call up your broker-dealer, could be a Morgan Stanley, could be Goldman a lot of times these days, or any other large broker-dealer. The number of those large broker-dealers has been reduced somewhat since 2008, 2009, but you will call up your large broker-dealer and say, I would like a quote for this particular transaction. They will give you a quote. You will trade it with them, and then that is essentially your transaction. And so the counterparty risk has to do with the fact that you are relying on the person on the other end of that phone to be there when you want to close out that position or cash it in. And as we saw in 08, 09, a lot of those firms were not there when the other side of when that call came in to close out or exercise those positions. So that is an enormous risk. And unless you're really certain about the firm you're trading with, that could really come back to bite you in the end. Of course, the other side of that, the few counterparties, is that the liquidity in these products is essentially non-existent. These are RFQ products for the most part. You request for quote. You're going to call up, ask for a quote, and you're going to get the quote. I mean, you may have some dissemination of some small bid-ask spreads here or there, but essentially these are primarily RFQ products. And so the liquidity is tantamount to that. You're going to call up, they're going to give you a quote reflective of the size you want to trade, and that's about it. And there's the actual ability to trade into and out of these products is limited by the fact that there's very little liquidity, and as a result, there's only one counterparty you're trading with, so the bid-ask spread is going to be enormous. So if you're looking to get in and out frequently, you're going to get crushed by that bid-ask spread, and that is definitely a component of these trades where most people put them on to hedge an existing portfolio and an existing risk, so they're not looking to, like we discussed earlier, dynamically hedge in and out or trade in and out of these products. They're going to put a vol swap or a variance swap position on once and usually leave it on until it expires. And so they're not concerned about dynamically hedging in and out or trading in and out. But that large bid-ask spread is also a large downside to these people. And of course, for a lot of our listeners, there's a downside that is transaction size. Your average 10-lot options retail trader can't call up Goldman and get a quote for OTC variance swaps. It's just not going to happen. So the utility of these products for a large section of the trading audience is non-existent. They simply don't exist for you. So unless you're willing to come in and do 1,000 or 10,000 of these contracts, you're probably not going to get a quote. So the ability for the bulk of the options trading audience to use these products and to hedge their risk with them is pretty much non-existent. That's the broad overview of the major downsides to the variance and the vol swaps. Anything you'd like to add to that, Don?
I think you've done a great job in summarizing, and you hit all of the key points. I would add one more, and it's actually something that our listeners can look at, because on the website in the resources section, we have a tutorial, and it's actually our entire PowerPoint slide presentation that we would give if we were speaking to an audience, and we've made it available online. And if they would scroll up to slide number 34 in the presentation, the title is Futures on Realized Variance, which are listed on the CBOE, although they practically don't trade at all. And one of the reasons why is these incredible margin requirements that can be forthcoming when volatility starts to rise. Variance is the square of volatility. So 20 becomes 400, but 40 becomes 1,600, and 60 becomes 3,600, and God forbid a time like around 2008, when we were looking at 70 and 80 volatilities, you square that and you start getting these 6,000 numbers for variance, and the source of the information is the CBOE website on their own site, and it lists the outright margin requirement that would apply to such a contract as volatility starts to climb. And it's hard to believe, but these numbers go up to close to $250,000 for a single contract. Now, that's not your everyday number, but your everyday numbers can still be in the $30,000 to $40,000 range. And then if you really have some of these spikes in volatility, which when squared makes variance even scarier still, the margin requirements can be absolutely staggering.
Yeah, that certainly makes for a tough pill to swallow there, some of those margin requirements. You're right. And then the next question we have coming in is also from the forum. And this is from someone who goes by the name Malaga14. And they want to know about the stickiness of at-the-money volatility. And he or she writes in, "Hi, guys. Really like the show so far. Keep up the great work." So, Don, this might be your mother writing in for this one. I don't know. We'll see. They write, "Don, in show number 2, you talked about a phenomenon of ATM vol sticking at the new level in the near term after a move up or down the skew curve, and then gradually changing later on. Now, this is a very interesting subject for us retail vol traders. I was hoping you could say more about it in a later episode. Would be particularly interested to hear about any historical studies of stickiness you may have done back at Morgan Stanley, and if there's consistency to the way this tends to happen. Does that suggest any particular trades when vol is stuck right after a big move?" And Don, since you have already extensively answered this in the forum, I'll let you run with this one, but I thought it'd be interesting to also bring it on the show and discuss it for our listeners who haven't had a chance to peruse the forum, and we could discuss it here as well.
Well, yes, I'll be happy to summarize what I said on the site, and I did mention that I'm going to try to see if I can do some research into whether there are actual academic papers that address this topic. I don't remember ever reading any, but I'm sure that it's an interesting one, and perhaps someone has already turned his attention to it.
Yeah, I racked my brain when I saw that question, too, about any sort of papers to this topic, because you're right, it is an interesting one, and I, for the life of me, can't think of any off the top of my head that address this specific topic, but I'll keep looking as well and see if we can find something interesting to post up on the site.
We'll try, but again, the phenomenon is a fairly easy one to explain. All of our listeners know about the volatility skew. Let's talk about equity for a moment. Got a certain at-the-money volatility, and then as you go below the market at the puts and calls at the 90% or 80% level of the current spot or the cash, the implied volatilities of the options start to climb. As you go in the other direction above the market, they start to drop off somewhat. And we've discussed some of the reasons for this and the need to buy out of the money puts for protection and the sellers commanding premiums. And then the buyers of the puts look to cheapen up the price somewhat. So they go above the market. They sell calls. That depresses the premium somewhat. And ever since the crash, we've gotten this asymmetry, no longer a nice symmetrical smile, but kind of a smirk or a skew. Well, what happens when all of a sudden the market moves fairly sharply, let's say 2%, 3% down in a single day? All of the options that had been at the money at a particular level, we now are at a different level for at the money. The market has dropped. And as the market drops, that level is associated, as we just mentioned, with a different implied volatility, in this case a higher one, than we had before the sell-off. So all of a sudden, our at-the-money options that might have been, say, a 20% volatility are now going to be maybe 23 or 24% volatility by virtue of the fact that there's a new definition for at the money, and it happens to be somewhat lower along that skew, which means that the actual implied volatilities are higher. Add to that the fact that all volatility may go up on a day like that, no matter where you are along the skew, and you might even get higher readings than the ones that I just mentioned. So all of a sudden, what you associated with an at-the-money volatility no longer is that number, but a considerably higher one. So the skew kind of sticks to where you are at that particular point. But the question is, and the part that becomes fascinating is, over time, let's suppose we stay in that area for a while. Well, are we now going to associate a 24 or a 25 implied volatility with at-the-money options when we've been associating a 20 for so long? Probably not. So what happens is that higher volatility starts to abate. It starts to shed some of those higher numbers and starts to return to the levels of implied volatility that we customarily associate with at-the-money options. And the question as to how long it takes to do that and exactly in what manner it does that is, I think, our questioner's concern and where I'd like to see further studies. I just know that instinctively when I was on the trading desk, I recognized this phenomenon and I realized that what we were calling at the money really had taken this kind of like a parallel shift, if you will. And we had in the back of our minds that given a little bit of time, we were going to start to revert to what people normally associated with the volatility of at the money options.
I think it's worthy to note, too, that this is an asymmetric phenomenon. We see enhanced stickiness to the downside rather than to the upside. I mean, there are cases when you do see, we used to call them on the floor upside explosions, upside crashes, where the underlying continues to rally through point after point after point, and that could blow through a lot of your hedges, and that could cause some upside panic and upside vol increases. But we tend to see when there's a pronounced sell-off or an unexpected sell-off, the explosion of vol is more pronounced, and the level of stickiness, I would say, tends to be higher too. We tend to stay at that higher vol for a longer period than I think we do when we rally to the upside and we hover at that decreased volatility level. Would you agree, Dan?
Yes, I'm sure you're absolutely right. And I think that it's probably somewhat psychological and emotional. When the fear factor is involved, it tends to be a stronger influence on these numbers than, if you will, the complacency factor to the upside. So nobody worries too much about the market melting up, as you said, or a crash to the upside. And everybody worries about what the downside might bring. And so not only is there an asymmetry in the absolute magnitude of the movement, but I think you're probably right that from the persistence point of view, it does stick around a little bit longer to the downside with respect to the upside. Again, I'd love to see all of this quantified. And in the weeks ahead, if I can find some research on this, I'll certainly pass it along to our listeners.
Yeah, I'll be looking forward to seeing any sort of academic studies on this. There has to be someone out there. Given all the research that's been done on skew and moving up and down the skew curve, I have to imagine someone at some point in one of those papers has quantified the degree of stickiness and perhaps even given it a name.
Well, Professor Peter Carr is a very good friend of mine. He's at NYU Stern School of Business. He's one of our most prolific researchers and writers on the topic of volatility. He was actually one of the pioneers of volatility and variance swaps. So I think he would be my first call, and maybe I'll drop him a line or give him a ring, and perhaps he can point me in the right direction.
All right, I think we have time for one more quick one here in the old listener mail before we close out the mailbag for the week. And this one is another one from the forum. It's from our good old friend Thomas, who posts in there quite a bit. And he asks, what do you think of the individual name VIX products on Amazon and Apple, etc., that were recently announced? And we've discussed these to a little bit of a degree on other shows, but we haven't discussed them to any significant extent here, and we've touched on them a little bit. But the question actually is, I'd like to hear the host's opinions on the new single name VIX products that will soon be trading on Amazon, Apple, and other liquid names. I am somewhat interested in them myself, but I'm not sure about their overall utility. And Thomas, I think your reaction was pretty universal, and people heard about these products at first. I think the predominant reaction from most professional traders and market makers and options traders was, why do we need this? This product is redundant. We can get all this information already from the implieds that exist in the current options. But then we saw some similar reactions to the rolling out of the weeklies, particularly the expansion of the weekly pilot last year. Why do we need these products? They're somewhat redundant. But then we saw a lot of interesting strategies emerging and a lot of interesting use cases emerging around the weeklies, and also a lot of interesting ways that the volatility performed in relation from the weekly to the front month, and that opened up a lot of opportunities for strategies there and ratio spreads and other things that traders could utilize to take advantage of those opportunities. And so I think the more you think about these products, the more they become an interesting thing to watch in terms of their interplay, not just with the front month vol, which they are obviously replicating or displaying through the VIX calculation, but also the interplay with the weeklies on these names. And all these large liquid names like Apple have weeklies as well. And so being able to watch how the weekly performs versus the front month VIX options versus the front month options themselves, that'll be interesting. I'm sure there'll be a lot of interesting arbitrage and a lot of interesting ratio spreads and trading strategies we can do based around the interplay, because I think there's still a relative degree of inefficiency between the weeklies versus the front month, and when we add a third name into that, like such as this single name VIX, it provides a lot more opportunity for trading in and out of those sorts of inefficiencies. So what do you think about these products?
Yes, I remember we touched upon this briefly when we were down in Boca near the croquet courts and that wonderful
Don't
session.
Don't remind me. I'm thinking of it wistfully already.
That we had, and I remember a comment that I made at the time that I think might be pertinent here. The strategies that you mentioned are all perfectly valid and present some good opportunities. Another one that we used to do purely with options all the time, and that could be done perhaps more efficiently with the single names, would be what we used to refer to as a dispersion trade. If you had enough of these on individual names, such that you could actually take an index, or perhaps even think of something like the Dow, and you had individual volatility contracts on the 30 components, you might consider the type of trade where you would buy the individual name volatilities while selling the entire index volatility and trying to capture some individual names that might go strongly in one direction or another and spike up in their volatilities, while it might not affect the index nearly as much, simply because you get movement that cancels out. So think about being short an index and long two individual volatility contracts on two names. One shows great volatility by going much higher. The other shows tremendous volatility by going much lower. You own those individually, but you're also short the index. Well, the index doesn't go anywhere at all because the two movements up and down cancel each other out. You're short that, which is good, but you're long the individual components, looking for dispersion of the individual names. So that's something that people might consider if there are enough of these to start to actually build baskets of them and trade them against an index that they might be components of.
Yeah, exactly. If they start to attract some attention and some liquidity, then you can pursue a number of these types of strategies. Dispersion is just one of them. It's always nice to have another tool in the old toolbox, I'd say. So it'd be interesting to see when these do start getting up and running, to see what kind of activity they attract, what kind of liquidity they attract, and what people are actually using them for, because I'm sure it'll be well beyond what everyone thought of when the products were first launched. All right, and that's going to close out the old mailbag for this week. I want to thank everyone who wrote in, and if we didn't get to your question, don't worry, we'll probably answer it on the forum. Don is quite prolific in there. You can also send it to us via Twitter or via email at questions@theoptionsinsider.com, or leave us the odd voicemail here at 312-544-9356. Just call up and tell us what show you want to leave a question for, and then make it pithy and fun, and maybe we'll play it on the air. And now we're going to roll right into the Crystal Ball segment.
And now we take a look at the Crystal Ball.
Welcome to the Crystal Ball. This is where we talk about what we're looking at for the coming week's worth of sessions, and we're going to toss it right over to our good old friend, the greasy meatball himself, Mark Sebastian, our volatility pitch reporter.
In my crystal ball is some sort of stabilization of volatility. I don't think that we're going to see a big increase in equity volatility. But I do think that we're going to stabilize. All right, that means that I think vol is going to stop dropping. Now, do I think it's going to increase dramatically? Doubtful. Okay, we've got Fed decisions coming up. We've got Europe. There's going to be a lot of things causing us to not want to do anything in the market, and so we may see small rises in implied volatility. But for us to sit here and think that there should be a big increase in realized volatility is kind of crazy. Now, the one thing that I think we are going to see this week is a shrinking of the spread between current volatility, or cash VIX, if you will, and forward volatility, which is what the VIX futures contract is. If there was an actively traded S&P 500 contract, on the Volex exchange, which they haven't listed that yet, correct?
No, they haven't listed that yet.
But it's something I think they're in the process of doing. Right now, the spread between the forward contract and the spread between the realized contract be really, really wide. When those two are trading, this would be one of those times where I would say buy the realized, sell the forward, because I think the forward is overpriced and I think the realized is underpriced. Another kind of interesting thing would be, the immediate IV versus that forward contract. One play I've been looking at is possible SPX straddles versus short VIX futures. Because I think something has to give on that spread as it's way out of whack. Another thing that I think to look forward to in my crystal ball, as I said in my peer report, is keep an eye on those commodities. They are way, way, way hot right now, and there is a ton of opportunity in there. All right? So keep an eye on options on gold, options on silver, options on GLD, options on SLV. Okay? And even more so, keep an eye on that spread between the two. All right? Pro traders that are able to swap GLD versus the gold options on futures should be seeing tons and tons of opportunity. And that's what I'm seeing in terms of my crystal ball.
And thank you for that, Mark. And Don, what else are you guys looking at over in the in Euro Vol land for the coming sessions?
Well, we're about halfway through the what we're calling the realized volatility period, or that calculation or accumulation period of the front month May 1 vol, or the 1 month volatility product. And contract is trading at considerably higher levels as the euro continues to climb. I think I saw 1.46 today, which is historically a rather high level. So the current contract is now showing a partial volatility halfway through the period of close to 11.5, and that's almost where the contract itself is trading, showing that for the rest of the way, traders are forecasting similar volatility. I even noticed that the forecast for the actual expiration value that's provided to us from Robert Engel at the Volatility Institute at NYU has climbed all the way to 10.63, which is higher levels than we've seen in a while also. That, of course, then gets reflected in the 3-month contract, or the June, and we're seeing that trading a little bit above 10, back out of the single digits. So again, we're almost halfway through to that 3-month expiration with about 30 days to go. So we continue to look at these price levels, and we see an increase, at least over the last couple of weeks, in the euro volatility.
All right, and that's going to do it for the crystal ball section, and it's also going to do it for this episode of Volatility Views. I want to thank my partner in crime, good old Don Schlesinger, for coming on the show this week. And Don, I know we talked about a lot of interesting papers that are going up on the Volex website. Is there anything else you want to tell our listeners about that they can find on volex.us?
Well, I promised volatility cones last week, and we have been working very diligently all this past week. Our webmaster has been doing yeoman's work in trying to do all the research and getting them together. They're not quite up yet, but they're right around the corner. I'm actually hoping that by this time next week, when you listen to us again, they will be available. So look for those volatility cones on a wide variety of assets as we continue to try to provide as much research and as much resources on the site as possible. Have a look at volex.us.
Well, that'll be interesting when that tool is finally up and running, our listeners can go in there and calculate their own cones and see when they want to sell or not sell, as the case may be, on volatility. And of course, if you want to post a question or a comment for Don or myself, then surf on over to theoptionsinsider.com/forum and post your question in the Volatility Views section. While you're there, you can also surf around. We have a lot of interesting analysis and content regarding volatility, as well as unusual trading activity, breaking news on the options market, and a host of other programs on the Options Insider Radio Network that are available there as well. Of course, you can also, again, leave us a voicemail, 312-544-9356, or contact us via Twitter at twitter.com/options or twitter.com/volex_info, I believe. Is that correct, Don?
Yes.
Perfect. Well, that's going to do it for this episode of Volatility Views, and we'll see you back again next week.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.